Live, guys. All right, welcome everyone. Welcome to this month's quarterly webinar here. While everyone's signing on, I'll just take a moment here to introduce Brett Greenspan, who will be leading today's presentation. He's the one that knows all the details. We also have Steve Geiger on with us too. He is our main contact at Morningstar. Sometimes that means he just gets to hear about any problems we run into. But Steve's not only been a good partner with us, with our relationship with Morningstar for many years, but also a good friend. So we're excited to have him on as well and help gain some perspective. I'm sure a lot of you jumping on today have concerns about the market. That's why you're here. So we're going to talk about what's going on a little bit more, hopefully give you a little bit more insight and direction to help you feel more comfortable with all the uncertainty we're facing here. So with that brief introduction, I'll pass it over to Brett. I am going to throw in the chat here a link to my calendar. So if you do have questions or just want someone to look over your portfolio again, look over your plan again, I'm more than open to do that. I know in uncertain times, sometimes just having a second set of eye on things can help keep you on the path. So with that, I'll turn it over to Brett.
Thank you, Josh. Good to be here. Good morning, good afternoon, everyone. Certainly a lot to cover today. And just want to say for those of you that are using Morningstar, thank you for trusting us with that responsibility. For those of you who aren't as familiar with Morningstar, going to give you just a little bit of an overview before we dive into some of the market activity and just give you some background on who we are and where we've come from. So again, thanks for joining us today. I'm going to go ahead and share a slide deck I prepared. And Josh, I'll just ask you to confirm once I get that up that you're able to see it without any issues. So just give me a moment here.
Certainly. And everyone, while Brett's getting that pulled up here, it looks like it loaded just fine, Brett. But feel free in chat to put any questions you have along the way too, and we'll help try to moderate that and get all those answered. If we're not able to answer something during the presentation today, we'll follow up with you with an email. So,
absolutely. All right. Well, gonna get started here, and as I mentioned, just want to give a little overview for any of you out there who aren't as familiar with Morningstar. And myself and Steve, we work with Morningstar Investment Management, which is a subsidiary of Morningstar Inc. And Morningstar Inc. was founded in 1984 based out of Chicago, where I'm located. And we really started as a research company. That's probably how you're familiar with us, at least initially. And what we were doing was providing independent research on mutual funds for retail investors. If you think back, 30, 35 years, really hard to get independent objective research on some of those newer mutual funds that were coming to the market. So that's how we built our reputation, was by providing and aggregating mutual fund research. And over the next 15 years, our reputation and our brand grew and ultimately launched our first managed portfolios in 2001. So we've been in the investment management space for a little over 20 years now and have gone from a pretty small operation in Chicago to a truly global organization. As you can see on the screen here in front of you, we've got offices all over the world, Australia, China, UK, India, South Africa. So when we talk about being a global organization, that's not just using international equities or international funds in our portfolios. We truly have a global investment team and a global investment management group. So just a bit of background for you about where Steve and I sit within the broader organization and the portfolios that we manage. Now, as you might expect, it's a huge undertaking to build these portfolios and to provide this research. So just a brief snapshot into the amount of coverage that goes into that. We cover 200 different equity and sub-equity classes, 150 fixed income asset classes, 30 plus currencies, a number of alternatives. So there really is a tremendous amount of research, manpower, and coverage that goes into building these portfolios. And it's just a responsibility that we take super seriously. So again, just a snapshot about who we are, what we do, and what we're really most proud of. But today's really is focused on the markets, and there's no shortage of topics to talk about. And it's certainly been a challenging first quarter, pretty broadly speaking, which I'll touch on in a bit here. And in the past, when we were talking about historical market performance, there was really always kind of a couple inflection points that you could point to. There was the dot-com crash or dot-com bubble in the early 2000s. And then there was certainly the global financial crisis of 2008, 2009. And for really the last 10 years, that's where you anchored most performance to. It was, okay, how we performed recently? How does the historical performance look back from the lows of 08 or even the highs of 07, 08 to the present day? But as we all now know, we've got a new inflection point where the market really saw a dramatic pullback. Uncertainty reached a peak, and our lives, from across the board, were changed forever. And that's the first quarter of 2020 with the proliferation of COVID-19. And again, that this has changed not only our financial lives, our personal lives, our work situations. It was really, if you can put yourself back in the headspace of the first quarter of 2020. There was a lot to be very scared of and very concerned about. And looking at the markets, it reflected a lot of that uncertainty and fear, right? So S&P 500 was down just shy of 20%. Small and mid cap asset classes got hit the worst, given some of the uncertainty around their balance sheets, the long-term outlook for their businesses. Value stocks got hit really hard. And as some of you know, some of those stay-at-home stocks, the more mega cap, big tech companies, those tended to outperform well. But broadly speaking, from an equity perspective, very, very challenging environment. Tons of uncertainty about whether we were going to get back to work in weeks, in months, in years. And I just bring that up because I'm going to touch on some of the uncertainty that we're facing right now. And just a reminder that even though we've got headwinds like the geopolitical issues going on in Europe, inflation, a rising interest rate environment, all of that, in hindsight, kind of pales in comparison to the amount of uncertainty we were experiencing with a truly the first global pandemic we'd had in about 100 years. Now, I want to point out that fixed income was a bit of a safe haven in the first quarter at that time. That's somewhat different than what we're experiencing right now. But 2 years ago, if you got out of equities, you got into government bonds or high quality corporate bonds, not such a bad place to be. So just a reminder about how the situation right now differs from what it looked like then. But I bring this up for one very important reason, is that right now, it's easy to feel like I want to get out of the market. There's too many different headwinds out there. How could things get better from here? Because I think a lot of us are feeling the same way in the first quarter of 2020. But as you're going to see on this next slide, the following 8 quarters were tremendous. This S&P 500 through March of this year, up 80% from the end of that first quarter in 2020. Growth in value up, somewhere between 75 and 80%. So really, a tremendous recovery, a tremendous performance that really would have been hard to forecast in March of 2020. Now, part of this you could tie to the monetary stimulus we've seen from the Fed. Part of it is the unprecedented fiscal stimulus we've seen from the US government. But I bring this up again just to highlight that, when we use a short-term time horizon, a short-term lens for evaluating performance or evaluating outlook, we can often get too emotional and caught up in the crisis, the crisis of the day, the crisis of the month. There are constantly different crises that are rearing their heads, whether it's COVID or any of those ones that I just mentioned that we're experiencing right now. But the long-term outlook for the market, long-term performance is generally a bit unpredictable from there. So I encourage you, as you're looking at your accounts, as you're looking at recent market performance, to try to take a step back and extend that time horizon to what your true investment time horizon is, as opposed to what we're experiencing in the moment. Now, let's talk about the first quarter. Again, let's shrink that time horizon down back into just what we've experienced through March of this year. And as all of you on the call know, it's been a very treacherous time for investors. Despite all the volatility we've seen, we're only down single digits in the S&P 500 through March. This is probably more like double digits, as it's been a very challenging April. But through the end of March, S&P 500 down about 5%. Unsurprisingly, small caps and mid caps were hit a little bit harder. Even large caps took a fairly large hit relative to the S&P, and that was primarily tied to some of those mega cap growth names, Facebook, Alphabet, Apple, Amazon, Netflix, Google, Microsoft. Those companies who saw, really tremendous performance over certainly the last 1 year, but really the last 3-5 years have been hit really hard. And that's reflected in that US growth relative to US value performance. Now, this is one of the biggest trends that we've seen in the markets really over probably the last decade, but it's certainly accelerated over the last 5 years, is the performance of growth stocks relative to value. In 2020, US growth outperformed US value by about 45%. That's a historically wide margin. So it's not a huge surprise to see US value outperforming US growth, as you've got some of these companies that have lower valuations. They didn't have the extensive valuation multipliers that we were seeing in growth names come back. Now, I'll touch on one of the key drivers there about why growth stocks are struggling. A lot of that you could point to rising interest rates, their earnings needing to be discounted back at a higher multiple, their borrowing costs likely going up from here. So there's a number of different drivers there, but I bring that up because that has been one of the key trends we've seen over the last few years, and it does appear to be reversing going back to the fourth quarter of last year. Another key theme we've seen is the continued underperformance of international equities relative to US equities. Now, again, a lot of that is tied to some of the headwinds they're experiencing right now with Russia, Ukraine. They also didn't have the same amount of fiscal and monetary stimulus that we saw here in the US. Now, I talked about in the first quarter of 2020 that fixed income was a bit of a safe haven for equity investors that were trying to reduce some of their risk. That has not been the case in the first quarter of this year. So a somewhat unique environment right now, because typically when you see this type of equity underperformance, there's generally some outperformance or relatively good performance for fixed income. But because we're experiencing this pullback alongside rising interest rates, that's really affecting some of the fixed income asset classes and portfolios out there. So at a very high level, one way to think about this is that there's an inverse relationship between bond prices and interest rates. So when interest rates go up, bond prices go down. When interest rates go down, as they have been, they've been historically low for a number of years now. So when interest rates are low, bond prices go up. So that's partly why you're seeing a pretty challenging environment for fixed income investors right now, is because for the first time in years, we're seeing interest rates go up, and that's negatively affecting bond prices really across the board. So just want to offer a bit of insight there and why this first quarter has been a little bit different than what we typically experience when you see equity markets in the red or underperforming.
Brett, I want to jump in there and ask
Please.
a question that's probably on a lot of people's minds is, especially in retirement, we're going to look to bonds, in a managed portfolio for more stability. Well, that's not working right now. And the Fed
Sure.
is, the plan is to keep ramping up interest rates. For how long should we expect to see negative returns? Not, of course, that you have the crystal ball and you can tell us an exact date, but, what does research tell you, looking back in time?
Yeah, it's a great question. And I think it's the question that's top of mind for any fixed income portfolio manager and fixed income investor is, how do we navigate what is the Fed is trying to do, which is a soft landing where they raise interest rates without sending the economy into a recession, right? So, one way that you can navigate some of these fixed income concerns and interest rate risk is by lowering your duration. So bringing down the time horizon of your fixed income investments from, say, like a 30-year to a 10-year, even a 5-year. Part of that is going to mean sacrificing some yield. So sacrificing a bit of the income generation from those fixed income positions. But the trade-off there is that if you do need to tap into this, your principal is likely to be less affected because you've got that shorter time horizon. So that's one way to navigate it. Another thing that we're doing in our multi-asset portfolios is taking a little bit of our fixed income exposure and adding it to alternatives. Alternatives is kind of a catch-all phrase, but really what alternatives are investments that are going to have less correlation with equity and fixed income markets. They've got more flexibility to target, say, incremental returns. They can use some strategies like going short, so selling investments at a high price, buying them back at a low price. They can employ strategies like convertible arbitrage, where you're buying something that's you're buying a vehicle that's going to convert either from equity to fixed income or fixed income to equity, and capturing a price discrepancy between the two there. So they're sophisticated strategies, but the point being that it's adding a layer of diversification and lowering your exposure to either interest rate risk or equity risk. And that's one strategy you can use to kind of lower some of the risk associated with that if you are in retirement. So it's a roundabout way, Josh, of saying that it's a challenging environment, whether you're an equity investor or a fixed income investor. But if you are in retirement and drawing from some of your investable assets for any number of things, whether it's a long-term goal or for your day-to-day expenses, diversification is probably never going to be more important than it is right now.
Hey, Josh, this is Steve. I'll also add that, folks working with you, they have access to Morningstar, but they have access to other situations as well. And I know you could direct people to other, say, fixed income products that maybe aren't as affected as inflation
Sure.
going up as, say, the capital markets are. That's one thing. And the other thing too is, like, not every bond category gets hit the hardest. I'm looking at this chart right now, and I see the high yield bonds, are not as hard hit it as the government bonds. The global inflation linked category. So like Morningstar is going to invest in, like, tips. So not all of the bonds we're going to own in clients' accounts are going to be the ones that are getting, in the crosshairs of the main, problem, if you will, or get hit the hardest. So Brett mentioned alternatives, and we're also going to find some other bond categories that maybe historically haven't always been hit hard. So
Sure. And I think, that's it. Outside of our managed portfolios, we do offer solutions to our clients. For those of you on here, you'd be familiar that we can use for stability of income in retirement as well. I think another thing that many people are still looking past that's providing stability and a decent return for more intermediate term money is inflation bonds. With inflation being high, that poses a great opportunity. However, limited investment. So if anyone's interested in learning more about I-bonds, feel free to shoot me a message too, and we can have a separate conversation about those as well.
Josh, last point I'll make is, so Brett,
Sure,
this
sure.
is an asset class return, say like corporate high yields, 4.8. But if the corporate high yield bonds are paying 5% or 5.5%, right? Then the income that the bonds are generating is slightly higher than the negative NAV or price. Is that right? Would that be right?
They're paying a percentage of the principal, so it depends, because if the principal goes down more than the yield, then that income is not keeping pace, and that also
Right.
is not accounting for inflations.
Right.
But Josh, I'll just add on one other point. I know we're going to touch on inflation in a few slides here, but I think there's also temptation when you see something like this to say, if there's nowhere to be, I'll just be in cash. I'll wait for another opportunity. I'll just wait for another 5% down, and then I'll get back in. And there's two big risks associated with that. One is that market timing is a tremendous challenge for the smartest investors out there, and so that presents it's easy to get out of the market. It's very, very challenging to get back in. That's one issue, and the other is that inflation is at this point running at anywhere from 6.5 to 8.5%, depending on what methodology you're using. And so in real terms, if you're sitting in cash, you would be looking at, you see red here, you see, anywhere from 5 to 8% on some of the fixed income positioning here. If you just had cash in real terms here, you'd see a similar number as well. So just something to keep in mind as you're dealing with the uncertainty and the fear of what you're seeing and hearing on TV, is that, action is not always the best outcome. Sometimes the best action is inaction, and to stick with the plan that you've put in place, because it's for times like these where uncertainty is peaking that you have that plan to anchor to. So just something I wanted to add there.
I appreciate your point about diversification, that now this is a good time. Great, there's a ton of red here, but if we were all in on Netflix because Netflix has performed so well over the last decade on average, well, boy, we're licking our wounds now, especially if we're in retirement. We need the money now. So yeah, I think that's a great point, and making sure that our riskier assets are not those that we're expecting to use now in the short term as well, so that we have patience to let the market recover as well. And I know I've had discussions with many clients and talked about in my webinar in the last month that, with the COVID downs, it was shocking how quickly we went back, right? The market is forward looking, so it reacted a lot quicker than our lives all went back to normal. So, although we have a multitude of factors that I'll let you get into as well, Brett, that doesn't mean that everything's going to be bad until all of those are resolved as well.
Yeah, absolutely. So I'll just continue on here with a little bit more of under the hood performance, at least here within the U.S. And probably no surprise to a lot of you here that energy has been the top performer over the last, call it 16 months. So just an explanation of what you're looking at here. This is showing S&P 500 sector performance. And what you're seeing in blue is 2021 performance. What you're seeing in red is year-to-date performance through March of this year. And again, for 2021, you could point to energy as the top performer and say, one, it was hit really hard in 2020, so there was a lot of room for recovery there. But maybe more importantly, as a driver, is that for a lot of the country, for the majority of the country, we started to get back out there, started to get back to our normal activities, whether that was traveling, whether that was running our businesses, whether that was manufacturing. And so energy costs, energy usage recovered in a pretty significant way. And that's partly why you saw energy as the top performing sector in 2021. Real estate, for those of you who've been in the real estate market or have been looking to buy houses or renting, you know that real estate's been hot. So no surprise again in 2021 that was the second best performing sector, and followed closely by financials and information technology. Now I'll touch on those in a little bit here, but financials is a sector that generally outperforms in a cyclical recovery. So that was part of our positioning in our multi-asset portfolios. And that certainly bore out last year. But when we look at 2022, as you saw on the last slide, not a lot of places you could be and feel good about your performance unless you're looking at it from a relative perspective. But energy has been far and away the top performing sector this year. You could tie this to increasing demand as, again, COVID restrictions have been removed, broadly speaking, across the country. But then you also had the secondary shock of Russia-Ukraine and the impact that's had on energy prices globally. So I think there was an expectation that energy would continue to perform well this year, but that's also been impacted by this energy shock tied to the Russia-Ukraine crisis. Now, somewhat surprisingly, utilities has been one of the better performers this year. And I say that it's surprising because generally in an inflationary environment, you don't look to utilities as a good place to be, partly because they don't have a ton of pricing power. A lot of their rates are set in nominal dollars. If they want to raise costs, there's a lot of regulatory red tape to get through, but you could probably draw kind of a secondary impact or draw a line between some of the concerns we've seen or some of the issues we've seen in energy markets and those elevated prices and elevated performance with utilities. Now, on the downside, and kind of leading the way on the downside has been information technology and communication services. Now, I touched on some of those mega cap names that had really, expansive multiples over the last few years. And when I say mega cap, again, I'll just emphasize really talking about those FANGM stocks: Facebook, Apple, Amazon, Netflix, as Josh mentioned, Google, and Microsoft. And those names have really driven performance over the last few years. But as we've seen rates rise, we've seen those names take a pretty significant pullback. Netflix was down, 30% in a day about a week ago. Facebook has had a really challenging start to this year. So that's part of why you're seeing some of those tech names, some of those communication services names lead the way to the downside. Now, just a good chart to illustrate how significant that outperformance was, and secondly, how dramatic the pullback has been. So what you're seeing in the blue represents those FANG stocks. They've left Microsoft out of this one. S&P 500 tech is going to comprise a lot of those names with some additional technology names, maybe not the mega caps that you see, but some other tech names you'd find in there. And then in the red, and yellow, you'll see the S&P 500, and then an equal weighting of the S&P 500. So for those of you who aren't as familiar, the S&P 500 is market cap weighted. So the largest companies in the S&P 500 have the largest weighting within the index methodology. So for instance, those 5 names that you're seeing, or 6 names if you include Microsoft, They have made up at some point almost 25% of the S&P 500, probably closer to 20% right now, given the pullback we've seen here. But we just talked about diversification. And so just a reminder, if you are investing in an index, while you are getting diversification because the S&P 500 maybe has 500, I think in fact has a little over 500 companies in there, about 25% of that allocation is going to go to just 6 names. So I think this illustrates really well how much the performance has been driven by those names and how much of a pullback we've seen in just a few short months here. Now, just kind of following up on that point, this is a ratio. This is the Shiller PE ratio. And what that is, it's a cyclically adjusted price to earnings ratio. And so it takes a 10-year rolling average of the PE ratio of the companies in the S&P 500. And I say that the methodology takes a 10-year rolling average to kind of strip out any 1 or 2 quarter outliers here. So it is a pretty quality methodology for avoiding significant outliers that could skew these numbers. But what you're seeing here is that we're still, even after a pretty challenging first 2 months of the year, we're still waiting on that 331 data. We're still at historical highs here. We're after, aside from the tech bubble of the late 90s into early 2000s, this is the second highest in history, higher than the Great Depression. So, even with the pullback we've seen, we're still at historical highs here. Now, I want to play the other side of the coin here, which is that we've seen unprecedented fiscal and monetary stimulus. Interest rates being historically low for an extended period has certainly played a part here and may support really elevated valuation. So it's not as if you could put all of these and say, in a vacuum, they're all equal. They all come with their different supporting market environments. But setting the stage there, we are still at pretty historical highs here from a price to earnings ratio perspective. Now, we're going to talk about interest rates and rising interest rates in a little more detail a bit later here, but just another chart that illustrates how low rates have been, how historically low they've been relative to average here. You can see that the historical average going back to 1970s, a touch over 6%. And we've been operating below 3% for sure, but we were below 2% even to start this year. I think we started the year about 1.6 for the 10-year treasury. Through March, this was 2.3. I think we've been up closer to 2.8 right now. So just a reminder, even though it seems like rates are rising really quickly, we've been at historically low rates relative to average for some time here, and there's still quite a bit of runway to get back up to that historical average. And so this is part of the challenge for the Fed, is navigating raising rates without stemming the economy or sending us into a recession. And it's going to be a tough landing. They've got to navigate this environment where they've got a tight window in order to do it responsibly, stem inflation, but not stifle economic activity. So just a kind of a helpful chart to illustrate where we are right now, but historically where we've been if you extend that time horizon. And then again, we talked first quarter 2020, we talked about 2 years of performance. We just showed you the first quarter of this year. But I do want to emphasize that if you take a step back, take the trailing 10-year performance, a lot less red on this screen, right? You've got a little bit there in emerging markets, fixed income. But broadly speaking, the last 10 years have been extremely fruitful for investors and really, really strong for investors who remain diversified. You can see really strong performance from the S&P 500, just shy of 15%, small, mid, and large, all in double-digit performance. And while growth over the last 10 years remains the strong outperformer, as we've seen, value is working to narrow that gap over the last 2 quarters. Again, we've seen international lag the US, but these things change quickly, as we're seeing in the first quarter here. So I'll show you a slide here in a moment that just highlights the importance of diversification. And that's what you're seeing here. So what this is showing you is the asset class winners and losers going back to 2007. That black line you see in the middle there is a 60-40 portfolio. And so it just shows you that you don't always need to be the best. You don't always want to be concentrated and end up in that bottom row there. You ideally want to end up somewhere in the middle. You smooth out the ride, average out that performance. So you're not taking too much risk to the upside or too much risk to the downside. So that was a lot. I want to pivot here to a discussion about the kind of the economic overview, what we're seeing from an inflation perspective, a GDP perspective, and naturally, hopefully for not too much longer, but this conversation continues to start with COVID-19. That's really driving, a lot of our discussion, a lot of the focus on economic activity and outlook. And it's been really great to see that, we're finally putting some of these major spikes in the rearview mirror. What you're seeing there, that spike between September and March, that was Omicron, which, here in Chicago came through incredibly strong and fast. We saw the numbers spike, really to, I think they were unprecedented levels relative to Delta or what we experienced in 2020. But we've certainly seemed to be through the worst of it, and that's allowing us to get back to the office, get back to our normal activities, eat out at restaurants, ideally just kind of get back to pre-COVID-19 activity and support a normal economic environment. Now, globally, it's not as clear of a picture. We're still seeing countries like China try to achieve a zero COVID policy, and that's presenting a lot of issues for the global economy. Part of that is that here in the US, we rely on China for a lot of our manufacturing, a lot of our supplies. And so as they experience kind of rolling shutdowns or things that are disrupting the supply chain, that's going to continue to present an issue until they get those numbers to a more manageable level, or potentially, set aside the kind of zero COVID policy they've been trying to achieve and get, somewhat closer to what we're doing here in the US, which is really try to manage this as we get back to a bit of normalcy. Now, just another thing to highlight that we have seen this activity pick up. This is looking at TSA airport checkpoints, and it's going back to April 2020 when we saw the shutdown. You can see, from really the end of March into the beginning of May or June, a 96% decline in airport security checkpoints. And you can see, through April of this year, we're almost back to those levels. You could probably say we're probably approaching 90% of the activity that we saw pre-COVID. So this is certainly very encouraging to see. Some of this is business travel, some of this is leisure travel, but broadly speaking, seeing increased activity in the airports is a good indicator that people are, kind of setting some of the concerns that they've had aside. They feel more comfortable getting out there and getting back to, again, a bit of normalcy that we had before COVID. Now, I touched earlier on when I was talking about the price to earnings ratio that we've seen really unprecedented fiscal and monetary stimulus. And this is a chart that I think does a really good job of illustrating just how unprecedented this is. What we're seeing here is the largest non-wartime stimulus in history, the largest since World War II. And we actually are likely to, I think this is through 2020 and 2021, this is going to look as big, if not bigger, in terms of the amount of stimulus that we've seen from the government. So just a reminder about, one, why we saw the strength of that recovery that Josh mentioned earlier is because we had a tremendous amount of support from the government. That was not mirrored in the same amount of scale internationally. That you can partly attribute that to some of the underperformance in developed markets and emerging markets. But just a reminder that, aside from World War II, which again, we're going back 80 years at this point, the amount of stimulus we've seen from the government is really, there's nothing to compare it to. So in terms of our GDP growth forecasts, these are forecasts from our colleagues on the Morningstar Inc. side. And we have revised these down a little bit. They were closer, I think it was 3.9% to start this year. Given some of the persistent inflation figures that we've seen, given the rising interest rate environment we've seen, we've revised that number down to about 3.5%. But we still remain bullish. We still think that the economy is in this recovery phase. Now, what we saw in the print this morning was a somewhat surprising reduction in GDP growth. And again, part of that is, it's hard to point to a single driver of that, but a lot of it is supply chain constraints. A lot of it is what we're seeing with inflation, higher borrowing costs. There's any number of headwinds that we're facing right now that's led to that somewhat surprising number. But broadly speaking, we're still seeing economic activity improve, and we think that that's likely to continue over the next 3 years. Now, Unemployment is something that was really top of mind last year. There was the kind of discussion about the great resignation. I think it's probably more fair to say that it's really been this great reshuffling where we've got this really tight labor market. People are looking to either increase their wages, move into a job that could be more long-term for them. But the unemployment figures are really encouraging if you are looking for work. It's the U3 number, which is the most commonly cited unemployment figure, sub 4%, in fact, 3.6%. And that's well below the historical average of 6%. And underemployment here. So that's people that are in a job where they think they're overqualified, or perhaps they're looking for more full-time work. Also well below the historical average of a touch over 10%. We're at just a little under 7% right now. So very encouraging to see that people are getting back to work, that really anybody who's looking for a job right now should have an easier time than they've had in recent history in finding one. Now, inflation. This is really probably top concern for a lot of investors, a lot of consumers right now. Highest in 40 years. I touched on some of what's driving that. A lot of it is supply chain issues. A lot of it is that, with people getting back out, with COVID restrictions being removed, demand really flips a switch overnight. We could go from 50% of normal demand to closer to 95 to 100% just by removing restrictions. But supply takes a lot longer to get back up to speed. A lot of businesses reduce their supply, they reduce their manufacturing activity because demand was so low. So it's going to take a lot longer for supply to catch up and meet that demand. We do expect that to happen as some of these supply chain issues and bottlenecks resolve themselves over time. But it's certainly creating an issue for consumers, for businesses across the board. Now, we revised our inflation forecast up from March of this year from 4.2 to 4.5. Part of that is due to some of the energy issues we've seen, and energy is one of the key drivers of inflation right now. And you again see on the slide here that the Russia-Ukraine crisis and the global energy issues that's resulting in is absolutely having an impact there. Now, one other chart just to illustrate, how aggressive this move in prices has been is gasoline prices. I think all of us on this call can relate to this. You can see that they've been historically low for a time. Really from 2016 to 2020, there was a bit of a spike in 2019. But as COVID came onto the scene, oil prices went way down, gasoline prices went way down, and now here we are at the highest point in well over 10 years. And again, I know you see a lot of headlines that the government's working to bring these prices down, whether that means more drilling or tapping into reserves. There's any number of potential short-term remedies, but ultimately, this is going to be tied to stemming inflation, stemming some of the concerns we're seeing about global energy and the issues going on in Europe right now. So in terms of a high-level outlook, we've seen those COVID numbers come down. That's probably the most important data point that we could point to in terms of getting back to a bit of normalcy, getting back to what we expect as normal economic activity. We did see real GDP grow last year, which was great. As you see, our estimated growth rates for last year coming at about 5.5%, and I just highlighted we're at about 3.5% for 2022. Now, in terms of the U.S. market, even though it's been a bit of a challenging first quarter at down just about 5%, we still view it as slightly overvalued. We've had a decade of tremendous performance, even just remembering that last year we were up about 25% in the S&P 500. We still think that perhaps it's a bit overvalued relative to some other capital markets, but that doesn't mean there's not opportunity. We think that for opportunistic and granular investors that you can be targeted in the exposures you want within the US. Energy is a great example of that. Financials, communication services is actually a bit more attractive now following the pullback in the first quarter. So investing with a bit of granularity, navigating away from some of those areas that maybe have more downside risk, I think is one way to try to insulate yourself from some of these headwinds we're facing. And then lastly, from an interest rate perspective, I know Josh asked about this, we discussed, but it's likely the Fed's going to continue to raise rates in the face of these high inflation numbers. I think the most important thing for them right now is getting inflation under control, and they'll have to do that responsibly and with appropriate messaging to avoid some of the concerns or some of the shocks that may follow with the equity and fixed income markets. So I do want to talk about some of the top concerns that maybe are top of mind for you out there. From our perspective, there's really three concerns, and we've touched on all of them briefly here, but really it comes down to Russia, Ukraine. I think that's top of mind for a lot of us out there. Inflation and rising rates. And more importantly, what can you do with your investable assets to navigate some of these issues? So I'll start with Russia, Ukraine, and I'll put a chart up here that I think is really illustrative of geopolitical issues and market outcomes. So what you're seeing here is a number of geopolitical events over the last, call it 30 years, and market performance over a 3-month, a 6-month, and a 1-year time horizon. And I'll ask, kind of rhetorically, if you see any patterns here, see any patterns in these charts? And I'll answer the question myself, is that there really is no pattern. It's these geopolitical events are entirely unpredictable. It's very hard to forecast what's going to happen, 2 years, 5 years, 10 years out. How could we forecast what the market's going to do over 3, 6 months, and 1 year? One thing I'll mention is that these events do not happen in a vacuum. Russia, Ukraine, that's not an isolated event that the market can say, here's what we need to manage around. They've also got rising rates. They've also got inflation. And these events are all intertwined with one another. So I just point this out to highlight again how unpredictable these events are. And it's a bit of it can be time wasted to try to say, I'm just going to predict what's going to happen to here and adjust my portfolio accordingly. So what we do with our portfolios, and I'll mention I think is appropriate in this environment, is to manage portfolios with robustness. And I'll get into that word in a moment. But really what I'm talking about here is building a portfolio that's diversified with respect to outcomes. You don't want a portfolio that is going to only benefit if we say have a high inflation, high growth environment or a low inflation, low growth environment. You want a portfolio that's got some positions that are going to benefit in a low inflation, high growth environment, and some positions that are going to benefit if we have the opposite of a high inflation, low growth environment. So building a robust portfolio with appropriate diversification, not just geographically or at a sector perspective, but in terms of how they react to market events, is really one of the best ways that you can insulate yourself from some of the concerns and headwinds that we're facing right now. So robustness is an interesting word for building a portfolio. So I just wanted to show you what we mean when we say robustness. And that top one is great, the condition of being strong and good condition, sure. But it's that bottom definition that we're highlighting when we talk about portfolio robustness. And it's the ability to withstand or overcome adverse conditions or rigorous testing. And I think that's what all of us want from our portfolios, right? Is the ability to withstand whatever the next adverse condition is going to be. I want my portfolio to withstand that so I can look back and say, yeah, it did pretty well. If the market was down, I don't want to be down by significantly more. I probably, sure, we'd love to be up by significantly more, but not if it comes with taking on additional risk that we couldn't foresee. So just a reminder about what we're talking about there. Now, the second concern, we've talked about this, is inflation, right? Highest in decades. I'll mention that we don't try to predict inflation. In the same way that it's very challenging to predict geopolitical events and the repercussions from that, it's incredibly hard to predict inflation. The Fed almost a year ago to the day was talking about inflation as if it was transitory. They said, hey, this is transitory. It's going to resolve itself as supply chain issues resolve itself. We're not super concerned about it. I think inflation was sub 3% at that point, I think around 2.8 or so. And here we are, 8.5% inflation. And that's, one of the Fed's dual mandates is managing inflation. So why should we, as multi-asset portfolio managers, think that we have an edge in predicting it? So we don't try to predict inflation. We try to manage for it. And one of the ways that we do that, as I talked about earlier, is trying to lower correlation within our portfolios. So add something like alternatives to the portfolio, or position with underlying exposures that may perform well in a high inflationary environment. Something like healthcare, consumer staples, certainly energy. So just getting back to what we discussed earlier about diversification, how to manage for these different types of market shocks. lowering correlation with broad asset classes is one of the ways that we try to do that. Now, Josh, you got a question? I see it popping up here.
Yeah, I want to jump in and drive in on correlation a little bit. So I want to have you talk a little bit more about what correlation means, because I think one of the things from the advisor perspective that we might see a lot is someone maybe shares with us a recent 401k statement, and they'll say, hey, you know what? This is how I chose the options. I went through and looked at the recent history and pulled the top performing ones, right? So if we think about that in the lens of the last 10 years, well, that might be all large cap tech heavy stocks, right?
Yep.
In that case, you might have 4 different funds, but they're all owning the same things and they're all going to move together. So can you talk about that correlation a little bit more to make sure that everyone understands, how that works in a diversified portfolio?
Sure thing. Yeah. So correlation is really, the easiest way to think about correlation from my perspective is that there's a range from -1 to 1. And so you're taking 2 assets and you're saying if these assets, so say I've got company A and company B, and if company A is up 10% over a year and company B is also up 10% over the year, and that the moves they make up and the moves they make down happen in the same way with approximately the same timing, you would say that they have a correlation of 1. Now, if you've got those same 2 assets, company A and company B, and when company A goes up 10%, company B goes down 10%, you would say they have a correlation of -1. So ideally, what you want to do when you're building a diversified portfolio, you don't want to have different investments in there that have a correlation of 1. You want to have investments that, you could say you want to go as low as -1 if you really want to have, opposites, but really you want to be somewhere in the middle there, close to 0, a lower correlation among your assets so that they zig and zag differently, right? So it reduces some of your risk to have assets that are going to behave differently in a given market environment. So, to Josh's point, if you have 6 different mutual funds, but they all have a growth tilt and they all are going to perform well when interest rates are low and tech stocks are performing well, just because they're different funds doesn't mean that you've got diversification. They're still behaving the same way. So what you want is funds or ETFs or whatever vehicle you're using that aren't going to behave the same way. They're going to perform differently in a market environment, so that when one is performing well, perhaps the other one is acting as a bit more of a safety valve. And if you see a down market, perhaps the one that was more conservative is going to anchor your performance versus the one where you were taking on additional risk. So ultimately, what you're trying to do is lower the correlation, but reduce these positions from moving in the same direction at the same time. That's ultimately what you're trying to do by lowering correlation. Fair, Josh?
Sounds good. Yeah, thank you. That was good. I think
Sure.
I even wrote down zig and zag differently, right? Like that's the easiest thing, right?
It is.
When one's doing one thing, you want it to do the other thing. And that's like a team approach. If we think about any sports, we need someone, I'm coaching my boys soccer now. And the biggest thing at their young ages is spread out and pass the ball to each other. And when you do it, it is the biggest competitive advantage at that age, because by default, they're all herding towards the same thing. Likewise, we want to do that with our investments. We want to have that diversification, be able to pass rather than have everything move in the exact same direction.
Yep,
Hey,
absolutely.
Josh, I hear your coaching correlation is 1, by the way. Sorry, had to throw that in.
Okay. Brett, did you want to answer Michael's question too?
Yeah,
he had posed here, since we kind of got you off your track to begin with there. He's talking about the overvaluation of the market. When do we recalibrate? So if the market's overvalued, when do we recalibrate? And should we?
I suppose it recalibrated. Maybe I should just pull up the question myself. In terms of recalibrating, so recalibrating, I suppose you can look at that in a number of ways. Part of what I'm talking about with diversification is you're always going to say you're a long-term investor and your risk tolerance is moderate. You're always going to have approximately, say, a 60-40 allocation, give or take. And so recalibrating in the sense that you're always going to have maybe some US growth, some US value, some small cap, some mid cap, some large cap. So it's not necessarily saying, I was in a 60% equity portfolio, I want to go down to 40%. It's how do we tweak our exposures within that equity component to reflect the areas that we want exposure and shy away from the areas that maybe we're more concerned about downside risk or downside a potential pullback. So if I could give an example about how we recalibrate, within our portfolios, we've shied away from some of those technology names, some of those communication services names, because we thought that the downside risk outweighed the potential reward from continued outperformance. And so we took the exposure that we might have there and reallocated that to, or recalibrated it in those words, to areas like energy and financials and healthcare, where we thought, okay, the risk reward here is a little more attractive. So it's really goes back to what I touched on earlier about being a bit more granular with how you're positioning within the equity bucket that you're kind of anchoring to in your overall allocation. So, I suppose that's, again, a roundabout way of saying that it's important to be a bit more active under the hood. You don't want to time the markets and say, oh, we think the market's overvalued, we better get out altogether. That's absolutely I suppose the opposite of the message I'm trying to make, which is that it's more important to reposition rather than remove yourself from as a participant altogether.
And Josh, I'll just add that I do agree with Michael that that's a fundamental thing to do. That's a good fundamental thing to do with your investments, is when things are going well, at some point to take some chips off the table and go elsewhere. But my point being is that it's not an all or nothing thing, because you can't time the market. But small percentages of it, absolutely. Take the winners, go elsewhere, and then let the other component come back where you went. So I think that's a sound strategy.
And I also, I'm rereading Michael's question here, and I see that he's saying, we've been saying the market is overvalued for many years. When do we recalibrate like our decision making, I think, or our evaluation of the market, as I think is what he's saying. And that is a totally fair question. There's a famous quote. I'm not sure if it's Benjamin Graham or who I should attribute it to, that the market can remain irrational longer than you can remain solvent, right? And so, just because you have a thesis doesn't mean it's going to play out in the time horizon or in the time period that you think it should. And so again, that sometimes you may be wrong, and sometimes being early is the same as being wrong. That it just is, it's a matter of perspective, it's a matter of time horizon. And I certainly don't think that our investment team would say, we know we're right about this and it's absolutely overvalued. But from our analysis, from the fundamental analysis that we do, we think that, broadly speaking, the market is overvalued. But again, there's absolutely areas of opportunity and areas where you can invest to see outperformance.
Yeah. I want to take this one step deeper again while we're still off track. Let's keep it off track. And one question that we had submitted prior to, and I think this gets a little bit more specific as it's with the individual stock portfolios. So the select stock baskets, in this case, they were talking about movements in the hair portfolio, and asking about, hey, there's been significant changes in the markets, like in interest rates, et cetera, but there hasn't been much movement in the portfolio. And I know, Brett, I know you're not the portfolio manager there, and certainly don't want to put words in someone else's mouth. But can you talk about it maybe through a more defined constraint, right? Because they're not going to take the hair portfolio and put it all in alternatives. That's not allowed.
Yep. Yeah, so it's a great question. And, I think the one thing to remember about a strategy like the hair portfolio that differs from maybe some other strategies, certainly from mutual funds, is that it's a very high conviction, concentrated portfolio. It's generally, the range is 20 to 50 holdings. It's been closer to 20 than 50 for a long time. I think it's actually probably closer to 25 to 30 individual companies in there right now. And really, it would necessitate, in order to make a change, certainly in order to sell one of the businesses we own, it would necessitate a change in our fundamental view of the business, that there's a change in the future outcome of the business. If our forecasting was wrong, how to what degree was it wrong, and does that change our outlook for the risk reward over the long term? So, I think certainly in the first quarter, if anything, that this is a time to be adding to positions. And I know that we have added to a number of the positions in the portfolio. Taiwan Semiconductor was one, Roblox was one. Adding to names that have been down is I think certainly what you want to see from a portfolio manager when they're having a down market or a down quarter, and trimming positions to the upside. And it's absolutely a fair question. Hey, how often or why isn't aren't the names being refreshed more in this portfolio? But again, without putting words in Matt's mouth, I'd say that these are companies that he spends a ton of time analyzing. He has a very high conviction about not only their short-term, but their long-term performance. And so in order to fully liquidate a position like he did, I think with Tencent was the most recent one, there would need to be a fundamental change in the outlook. And with respect to Tencent, I think he mentioned in his commentary, but loves the business, but was uncomfortable with the regulatory environment in China, and that changed his thesis on whether he wanted to own the business. So just a recent example, but it really comes down to the fact that there's only so many names in here. These are companies that Matt believes in, has fully dived into from a fundamental and valuation perspective, and so it's probably not super surprising that it's a relatively low turnover strategy.
Okay. Very good,
Josh,
Brett. Thanks for letting me get you totally off track there.
all right, then I'll stop. I was just going to add something because I'm really messing the track. So let's get back on track.
I've only got a few more slides here, but with respect to rising rates, I've touched on this a lot. I just want to talk about how you might combat a rising rate environment, and a few things that we look for is value stocks relative to growth. Historically in rising interest rate environments, value has outperformed growth. That's absolutely what we've seen in the first quarter of this year, with about a 14 to 15% disparity between U.S. value and U.S. growth. Also investing in companies that have moats, or what we call moats, but they're really high quality businesses with sustainable and growing competitive advantages. And those companies tend to perform well because, as you see here, they've got greater pricing power. They can insulate themselves from some of the inflationary concerns that we're seeing. So, for example, a company like Visa or MasterCard, which are in that hair portfolio, if prices go up for consumers, at restaurants, at shopping, wherever they're spending their money, Visa and MasterCard don't have to raise their costs. That just feeds directly through to their bottom line. So, and then you think about a company like Facebook or Alphabet, where prices go up, their consumers are going to pay it. They have the ability to pass along that cost to the consumer. So whereas we as the consumer ourselves, this is a negative, but as investors in those businesses, that's the type of business you want to invest in, one who can pass those costs along and then feed into their bottom line. And then lastly, we touched on fixed income versus alternatives, but just a way to lower some of that interest rate risk by taking a slice of that fixed income. We certainly don't advocate taking all of your fixed income, but maybe taking a slice of that, adding it to an alternatives bucket, and lowering some of your correlation there. So again, we've talked about all of this. I know we're up against the clock here. I do want to leave you with this slide, though. I think this is a great slide for our current environment. And what you're seeing here is 3 different examples of activity following the 2008-2009 GFC and investing in the S&P. So if you started with $100,000 in about 2004, 2005, then we got to the 08-09 crisis, and then you either did nothing, so you bought and held, you moved to cash for a year, or you moved to cash entirely. And if you just look at the outcomes here, that was, again, another period of peak uncertainty that we actually, there was a significant impact on the economy. It took a number of years to get out of that. But if you just bought and held that 100,000 through that entire time period, you would have ended last year with about a little over 700,000. Now, if you stayed out of the market for a year, just 1 year, so you were back in around 2010, 2011, your returns were almost cut in half, 440,000. And if you stayed in cash, you said you got out, but it was too hard to get back in. You kept waiting for another pullback, waiting to get back into the market. You made about $30,000 versus just buying and holding for about 700,000. So just a reminder, about how detrimental it can be to be out of the markets, how important it is to anchor to your plan, and to, again, remove emotion, avoid some of the uncertainty and fear that comes with any number of the headwinds that we're experiencing right now. So just a powerful illustration here I think you should take with you. And here's the last Graham quote I had for you, that the best way to measure your investing success is not whether you're beating the market, but by whether you've put in place a plan and a behavioral discipline to get you where you want to go. So, Josh, with that, I'll stop. I know we're a little over here, but I'm happy to stick around if we do have any questions that we didn't get to.
Sure. Yeah. If anyone else has a question, feel free to throw it in. I don't think I saw anything else in the chat. I would say, going back to your last slide too, let's always remember, and I think for us leading this webinar as well, it holds true for us as well. But when we look at that last chart, and if you stayed invested the whole time, going back through the financial crisis, that downfall in COVID from a dollar perspective would also be extremely painful, right? We can see that it's a larger drop dollar-wise in there. It doesn't go away. So we need to, plan and make sure that we're keeping our investments in the right mind frame. Certainly someone in 2008, investing was at an earlier part of their career. And right now they might be looking at retirement. So, your allocation needs to evolve with you as well. And we don't, I'm not saying that to say, hey, you have to be all in cash when you retire, or all in bonds, or all in conservative investments. No, you certainly should have it bucketed out where you can get that long-term compounding growth and sustain market downturns like we're seeing here. But it doesn't go away. And, in every market downturn, I'm sure even looking at the data, Brett, sometimes you're like, well, what if it's different this time, right? And I think for me, it was really enforced with the COVID shutdowns. I never thought in my life that I would be told to stay home, our whole country would be shutting down. But look at how fast everything jumped back up. So, try to keep an eye, happy to talk with anyone individually on their plan to make sure that they have enough of a timeline, even if we do have a sustained downturn, that they can stay invested. And I think that that's the important thing in navigating the markets as an investor, is having faith in your investment plan and making sure that it fits your life stage as well. Brett or Steve, did you guys have anything else to add today? I know we're about 5 minutes over already.
Not for me. I'll just add that I always love the opportunity to speak. And if anyone does have any follow-up questions, by all means, I'm happy to answer anything that we didn't get to, or that somebody wants to follow up with. So please feel free to pass those along if they do come in, Josh.
Okay, certainly will do. Well, thank you so much, Brett, and thank you, Steve, for joining us, and thank you, Morningstar, for supplying the great research as well to root our conversation, and look forward to seeing everyone again next quarter.
Thanks, Josh. Thanks, everyone.
All right, have a great day, everyone.
Yep. Thank you, everyone.
Bye.